Hi, everyone, and welcome to Bitcoin Analysis Beyond the Block for March 2025, proudly brought to you by Ainslie Crypto. I'm here, my name's Chris. I'm here with my panel of esteemed guests, as always. Welcome for another, say this every month, another exciting month, but this one is exciting probably for the wrong reasons. How are you going today, Joe and Isaac?
Doing great. I think today's going to be quite an interesting video after such volatility since our last update. So yeah, definitely a lot to cover and it's going to be great.
How are you, Joe?
Excellent. Glad to be an esteemed guest.
Always an esteemed guest. Now, look, we've followed the same format. We'll continue to follow that format. I think it's working. If you have any feedback, always give us that, and we can continue to tweak. But we'll look at the big picture macro first, then we'll get into some of that Bitcoin market analysis specifically. End up on the technical analysis, which is always a fun place to be, particularly when Isaac was right on a few things that we never like to mention. So we'll get that out of the way first, so we don't have to mention it again. Let's start off with the macro, Joe. We've had a new dot now on our chart that is not really showing us a whole lot of life. It's still sitting back down there, well below that 50 line. What's going on in the big picture macro?
Yeah, well, and just like our charts, I suppose the macro picture at the moment is a little bit blurry. If you've been living under a rock and you haven't really been following the Trump tariff news and the market's eventual reaction, because it's not like this is new. Yeah, it's a little bit murky, but we'll go through the charts and we'll sort of lay out a bit of a plan of where we think we are and the potential direction we're going to be heading if certain market events occur.
When you look at this chart in particular, I mean, you're looking there at a mixture of global liquidity and the macro cycle itself. And when we talk about the macro cycle, the thing that really captured our attention this month, when you and I were talking about it, particularly, was this: that coming out of the US, and you mentioned the Trump tariffs, you mentioned just uncertainty generally. This chart was really showing that play out because last month it was looking like we're off to the races with growth. That seems like it's come to a screaming halt. That leading indicator is still sitting right on that 50 line, but it's certainly changed the picture very quickly.
Yeah, we're looking at those forward orders in particular. I suppose there was a lot of imports taking effect in the US before tariffs came in, so inventories were really starting to load up, which is why you're looking at that orange line pointing having a reasonable increase. But now that we sort of know that around April the 2nd the tariffs are going to be implemented and inventories are already full, you can expect that potentially not a lot of that new orders are going to necessarily need to come in. We're talking about its effects on inflation and going forward, it may not have an immediate effect of inflation, but if the tariffs do carry on, we may see inflation starting to tick up as well, which is obviously going to be our next chart. But I suppose if we're looking specifically in manufacturing and the servicing part of that, the tariffs have just brought in a lot of uncertainty. We had been talking over the last couple of months how we thought we were going to get some sort of certainty around around how Trump wanted to drive the economy, but when your input costs all of a sudden go up and consumer sentiment starting to drop, it makes it very hard to plan for.
And that's my biggest issue with what's going on at the moment, is it's not certain at all. When you were sort of saying, we get some clarity emerge because on April the 2nd, we know what happens. Well, we don't, because at the end of the day, we've got an administration that likes to change the rules all over the place, depending on the latest conversation in some of these situations. So you and I have been talking about this quite extensively, the fact that this may be very deliberate, that you need this actually to fall, which is something that you don't usually hear coming out of an administration, but we certainly have been hearing that they really want to slow this growth down. Why would that be the case?
Yeah, so if you're looking at this ISM chart, at the end of the day, they want to bring growth down and they want to bring inflation down because they want to bring yields down, right? So we know that towards the middle and back end of the year, there's $9.3 trillion of debt that needs to be refinanced, and if you're trying to refinance that at 4.3% or even potentially higher, that's that quickly, as we've already seen over the last couple of years, becomes an exponential growth in the debt cycle. So it's like at the moment, if you can't get those yields down, it's like you're issuing debt. You've got a credit card, right? And you can't pay it off, so you go get a more expensive credit card with with a high interest rate to pay off the old one, and then you just can't keep doing that. So what they're really trying to do here in terms of Besant and Trump is slow down the economy, and the byproduct of that is lower inflation and it's slower growth, especially in terms of market sentiment. We'll talk about market sentiment and the markets as well and how that has its effects. But yeah, it's obviously starting to flow through to inflation, which is clearly pointing a lot lower than the official numbers at the moment.
Well, in some ways, that gives them the leeway to be able to make some of these moves, because certainly the concern from a lot of people is that the tariffs in particular are going to be inflationary at some point, that they cause by almost by definition. When you add an extra cost on top of something, it's going to add some level of inflation. But if there was ever a time to do that, now is probably that time, just purely based on looking at that chart.
100%. And I think what when you've got Besant and you've got Trump on there on the news media outlets or tweeting just about every single day, and they're really trying to reinforce the message of the 333 policy, right? So it's bringing debt to GDP down to 3%, trying to get it down to 3 from 7, which is a big move. You've also got growth. They want to bring growth down to 3%. It's currently around 4 to 5%, as recent history has been. And then they also want to knock out 3 million extra barrels of oil a year. So like all those things are going to be deflationary. They're going to be anti-growth. And the end goal is to get the yields down. So if there's a bit of pain during the course of those things occurring, then it seems at this point that they're happy to let that happen for a while.
Now, some people might be going, well, okay, I don't need to know about all that because we're talking about Bitcoin here. That's what we're, I'm tuning in because I want to talk about Bitcoin. It's all relevant, and that's why we approach it this way. We need to start with the big picture first. And the reason for that is particularly our angle on global liquidity. We know, looking at the global liquidity data, that it's highly correlated with world wealth. And in particular, it's highly correlated with Bitcoin. We've known this for a little while, and this chart really brings that home. When you think about what that's showing there, you can really see that Bitcoin is probably the most responsive asset on average to what's happening in global liquidity, which is highly driven by what you were just discussing, Joe.
Yeah, 100%. So, liquidity drives Bitcoin and it drives stock markets. If anyone's been paying attention, we've had quite a sharp sell-off in the stock market over the last couple of weeks. And, you can just about tick for tick time it with the Bitcoin sell-offs and small bounces as well. So I know that this is specifically a Bitcoin podcast, but all these things matter in the larger macro picture. And
talking about that, like in terms of the larger macro picture, this chart here is showing that this is not uncommon. Like, this goes right back to 1970. This is what we do. We go up, we go down in terms of the amount of liquidity in the system. From what we just showed, there's that correlation link back to Bitcoin. So we know that the ups and downs are going to correspond. Even though we haven't had Bitcoin since 1970, we can have a pretty clear idea of how it would have responded during those various cycles because of the nature, its core nature of what it is and what its purpose is. When you look at, if I zoom in a little bit and look at where we are today with that liquidity cycle, it's a bit of a mess, which is what we highlighted in the very first chart where we were overlaying sort of liquidity and the macro cycle. What's your take on that here? Because is this one different to every other cycle we've had since 1970, or does it eventually end up playing out the same way? How do you think about it?
I think if what you're asking, if it's the end of the cycle, I would say no. It doesn't necessarily mean we can't have drawdowns in the markets while we're sort of in these tightish liquidity conditions. And we'll talk about that later on in a couple of charts that I brought along. Whilst they're trying to get growth and inflation down, and that has a negative impact on markets, it doesn't necessarily, it can't last for too long. It just has too much of a negative impact on the economy. You're actually shooting yourself in the foot when it comes to running the deficit and trying to reduce the deficit. So whilst it's still, liquidity is still very low, and you and I have discussed that we don't believe this is the end of the cycle, just a bump in the road.
Absolutely. I think exactly the same. And part of the reason is that I think that is what you just mentioned about it really can't get that low. We have actual constraints in the system that we need liquidity coming in. When you look at the central banks or the major central banks of the world sort of zooming in on this heat map, the US has started to put some money in. That's a little bit technical. It's not really that they've really turned on the taps. It's just that it's that time of the year where they tend to inject more liquidity into the market. And we're about to go into a time of year where they tend to pull liquidity out of the market. So that could be problematic. But you look at that right edge of that, we're not seeing a whole lot of green there, apart from that Fed input, and the aggregate is not looking great. So we still believe that at some point we're going to see significant injection because it's just maths, right?
Yeah. So if you want to, get into the technicals a little bit of this chart, the Federal Reserve's the only green one there at the right at the moment, and that's had a lot to do with the $300 or $400 billion that has been drawn down from the TGA, right? So even though that's the government spending money, the TGA is the bank account that the government has with the Fed. So we class that as Federal Reserve liquidity. Now, obviously, that's been drawn down to, I think it's about 300 billion at the moment, or 300 or 400 billion. That obviously cannot continue on. It can only be drawn down so much, particularly when you're looking at the next 3 to 4 weeks, which is why we're somewhat cautious over the next 3 to 4 weeks, where we're approaching tax season, and that's usually quite liquidity negative as money comes out of the banking system to refill the TGA. So when the TGA is getting refilled, that's a negative. That's net negative on global liquidity.
Now, Isaac, I'm going to come to you in a second because I know you've got some very specific takes on this when we look at the market. But Joe, before we do that, I just want to tie in what you've said with what we're seeing in Bitcoin here. This chart is one that we're getting really excited about. The tiniest little tick up on the end of that we're starting to see the rate of change of liquidity improving. And when you look at Bitcoin on a logarithmic chart, you go, pullback, what pullback? It just looks like a blip. But it's interesting here because that little kick up is not exactly rocketing off to the moon, is it? Like it is just a little tick up, and we really need to see that accelerating to get really excited about the potential for that liquidity to push Bitcoin higher.
Yeah, well, and the way that this chart is calculated, it's all based in US dollars, right? And we've had an absolute dive in the US dollar over the last couple of weeks for various reasons. So therefore, what that actually does is the nominal amount of US dollar liquidity rises because every other currency that has putting liquidity in the system is all of a sudden more valuable in US dollars, if that makes sense. So that's why we're a little bit skeptical also of this current rise in liquidity, because it is once again off the back of quite a fast weakening of the US dollar, which we don't expect to continue happening over the next few weeks.
And your sort of final take on this here, tying the liquidity angle in, we have in the recent weeks, which we were talking about, a lot of that driven by the US, we have seen a tick up in the liquidity number. So we've seen more liquidity coming into the system. Whether that's sustained or not is we have a big question over, unless some other policies are enacted. But when you look at Bitcoin here, traditionally we would look at this chart and say, well, liquidity is pushing up, so Bitcoin should be following, right? Like that's how we would normally look at it. And that's probably very valid, because if you look at we always have this problem. If the two lines are pointing the opposite direction, one of them is wrong, and the one that's wrong is Bitcoin. Like we always know that, or we're very confident in that. This time I'm not so sure. I'm actually wondering here if Bitcoin is front running a little bit the expectation that we are not going to see the liquidity taps turned on unless there's a deeper correction in the market. What's your take on that?
Yeah, absolutely. And that goes back to what we were talking about in the previous chart. We've had rising liquidity conditions on the back of a weaker US dollar and a reduction in the TJ, which we just do not expect to continue happening over the next 4 weeks. Now, it's not to say that Bitcoin's going to come crashing down. Like, we've already had a reasonable correction, but in terms of where we are, it wouldn't surprise us, and we'll talk about that later once again, that if we do get a lower low.
So with that background, big picture stuff, Isaac, I'm very curious to see some of your market analysis, because you keep bringing the same tools back each week, which is so helpful to allow us to see this unfolding in real time. And you have flagged some caution on this before we we got to where we are, we were still, if you look back a month, we were quite bullish because at that point it was still looking fairly good. But since then we've had a month of policies that have been very deliberately undoing a lot of the momentum that was in place in the economy prior to that. So it's not that we necessarily just, that we've got that completely wrong. We've had a lot of outside influences. What are these metrics now saying?
Yeah, so the MVRV, when we did the last video, we didn't fall off the cliff yet because that was a month ago, and Bitcoin moves very fast. So since then, we've obviously had a large retrace in the Z score. It's actually unlike previous cycles where you look at where we are in the timeline, and I think that's really due to the policies and the uncertainty in the market with Trump and with Bassett. So there's all these different things that are adding to this, right, that create that volatility. So it's very hard to now compare that to previous cycles and be like, okay, this is what we expect. But I like to use this more as a gauge on how's the market feeling? Are we overheated? Are we not? Well, clearly we can see we're not overheated. We're actually in a massively oversold territory. That being said, we can still drop lower, and there's a few charts to suggest that we might. But we're in a stage where the market's not overheated. There isn't mass euphoria, and we're just in a consolidative period. And that's representative right here.
This chart is one I've been paying very close attention to, particularly the other day when we saw it down around that 15. that was unprecedented, the sheer level of fear in the markets. Now, normally I would be taking that as a back up the truck signal to go very long in Bitcoin, because usually this is a contrarian indicator, right? Like when it's that much fear, that's what you do. This time, I don't know whether I'm falling victim to the fear a little bit as well, but I'm cautious. I'm sort of sitting on the sidelines a bit, not in that back up the truck mode because of those bigger issues that we're talking about. How are you looking at this right now?
Okay, so you have to view this from two viewpoints. So the first one is, okay, if you were to view it from a purely technical perspective, yes, it's bullish, but that's why we have this framework which we look at other factors too, to formulate a better plan and have more of an edge. Because if you were to look at this and say, okay, every time we've reached this region, that is the buy zone. Yes, long term, this will obviously be, in the grand scheme of things, yeah, it's a good buy zone. But locally, if you're trying to get a good entry, on the backdrop of what we know on the macro, it might not be. But yeah, so what obviously happened going into this low where we are now, we had a lot of technical things. We had the 60-day cycles, we had the weekly cycles, and everything was pointing to a recipe for, we're going to be seeing a massive pump up, which we might absolutely could see that. But yeah, a lot of people are obviously, when we close that CME gap, which I'll go into that in the next few slides, everyone was now switching, saying, everyone was posting on Twitter, the fear is really exhausted, or blah, blah, blah. All this stuff is happening. It's time to get long. So that's why I'm also cautious too from a technical perspective, because there's a lot of liquidity on the downside, and we'll see that in the liquidity chart later on. And by liquidity, I mean more as in stop losses and liquidation levels.
Liquidation levels, yes.
Yeah.
Now, your sentiment analysis, you introduced this FOMO finder a couple of, or the last video, a couple of videos ago. You've gotten a different color here now. So does that give us a bit of a sign as well?
So purple means fear, as we can see. It's coincided with every major pivot low. And it's what you want to see going into the cycle. And I was talking about we could see either a timing-based cycle or a flush. And it's very clear we've seen a giant flush. We've seen a stack of leverage get wiped out. We've seen the market capitulate pretty much. But that doesn't mean it has to reverse right now. I do think honestly, I'm also more biased towards a bit more consolidation, maybe take out a few lows, but I'm not hyper bullish right now, even though you technically should be if you were to view it purely technical, but that's mainly because of the macro backdrop and what you guys were saying too.
Yeah, and this is very hard for people to comprehend because most people fall into one branch or the other. That's why both of you are here, right? Like you tend to look at more at the technical, Joe tends to look more at the macro. When you can bring those two together, that's really powerful, because just relying on one actually can be a recipe for disaster.
Absolutely.
And people have found themselves in that situation so many times. I mean, when you look at the RSI, it's not exactly crashing there, is it?
Yeah. I think what this shows to me is being below that EMA. I just think it shows that we could be ranging a bit longer than people expect, opposed to just shooting up. Because Twitter, Twitter's my sentiment gauge. And there's a few camps. So there's some hyperbulls that are just extremely bullish, thinking we are going to be rocketing up. Especially after reading that poem from who was that guy's name? Josh something on Twitter. And that was trending. And he was saying we we're going to hit 84K and then we're going to rocket to 444,000. So, retail might be looking at that and be like, oh, dude, just get in. But I'd be a bit cautious on the back of what we've obviously seen.
And people love a good narrative. And I think sometimes when we talk about retail in particular, I do wonder if there's all this imaginary money that's actually sitting there, because a lot of those people would have already been in, or going to be in. So yes, new money might come in, but that's not a quick process. And I don't think they're watching closly.
And I also,
oh, it's down, I got to jump in today.
Yeah, and I think the concept of retail is also slightly changing in the sense that a lot of people have already heard about Bitcoin before. They've heard about it now. Like 2017, it was all fresh still. Most people have heard about it. So I don't think the mass euphoria has to happen the same way it has in last cycles. But you'd still expect, humans are humans still. Psychology is going to play out. So you'd still be expecting similar things to happen, but it may not be in the mass scale that it's always been. But I guess time will tell.
And it's certainly, if you look at your Google Trend data here, I mean, it's elevated, but not at that sort of spiky highs.
Yeah, it's not. You can see it's sort of lackluster there after that November Trump season.
Where it did get a bit higher. Now, you also talked about active addresses. You've mentioned this a few months now as a potential indicator to judge what's going on and how many people are interested or at least participating in the market. Is that giving us any new insight?
Well, it's still holding above the red line, so that's a good thing. But other than that, I mean, there's not really much to draw out of here other than we're just ranging, because we're not trending up, we're not trending down. We're in this range. So, I mean, honestly, it's hard to draw conclusive data out of this. And you can see, when the network was first founded, there was a large growth in activity. Since then, we've sort of just been ranging on a more macro level since that 2018 top, according to this metric. So yeah, what we would like to see going further on, especially as global liquidity ticks up, is that increase in activity. So that's something that would coincide with a cycle top generally. So
we can wait and
we have to be patient, I guess.
Now, the other thing that has been getting a lot of attention, well, at least my attention of late, is these funding rates. Now, Joe and I were talking about this quite a bit, actually, that we haven't seen really sustained periods of negative funding rates, which is where, well, I mean, Isaac, you might want to explain what funding rates are a little bit more, but we've had these back to front. That doesn't really show up, particularly on this chart, but in the markets that we've been looking at, it's been sustained for a little while now, which is quite interesting.
Yeah. So funding rates are on the perpetual market, and they used to balance the perpetual market to the spot market. So it just depends if one side is getting more attention, like the long side, then shorts have to pay, etc. So what we're seeing now is, well, we're not really negative funding. You can't really say that. It's more so just very much minimal right now. And what you see when there's a lot of longs in the market, you can see during that 70K top that we had during that 7-month range, it was very overheated. So if you were getting in a long, you actually had to pay to be in that position. So, right, and that's actually generally a good indicator that the market is one-sided and can actually sort of time pivot points in terms of where we're going to see like local tops. And what we've seen now is, in a bull market, you only go into these negative funding rates, not much. So that we also have to keep our eyes on that and look at that logically and say, okay, well, how red can we go? And to me, I think we have a little bit more, and then we should start to see a reversal. If not, then I have to be reevaluating my thesis. And I'm not afraid to do that, but as the data presents, it's looking good so far.
And just to clarify that, I mean, it depends which exchange it is as well, of course.
Yeah.
But
I think this
we were looking at, it was very negative, and it has sustained negative, which is the unusual part from our observation. Because usually it'll spike negative, like you get that when there's big sell-offs, but it doesn't sort of stay there. It often stays positive, as you can see clearly on that chart. But I thought that was very interesting.
Yeah, 100%.
Okay. just lost my screen here. Here we go. This monthly Bitcoin analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy, sell and swap gold, silver, platinum and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenised gold or silver anywhere in the world, check out the Gold and Silver Standard for security of real-world precious metals combined with the flexibility of blockchain. Okay, Joe, you did bring back, you didn't have this last month, but you brought it back again for us this month to see how the ETFs are going. Do you want to start us off there?
Yeah, just adding to what Isaac was saying, I think in terms of not just sentiment, but also in terms of funding, with the premiums on the futures collapsing, which is why I think we're seeing a lot of these negative flows within the Bitcoin ETFs. So at one point we'd had about 500, I think it was 560,000 Bitcoin net inflows, and now we're down to 510. So we've had 50,000 Bitcoin outflow over the last couple of weeks, or 2 to 3 weeks. And, obviously some of that's going to be just due to poor sentiment, a lot of fear in the market. And the other part of that is, like I said before, premiums have absolutely collapsed. So that those hedge funds doing those basis trades, there's no money to be made there. So they've just pulled their money out. But I suppose if you're looking at it from a positive light, at the end of the day, there's still 510,000 Bitcoin net positive inflow since the ETF's launch, which I think is fantastic when, you got that sentiment gauge that Isaac put all the way down to 15.
And you've talked about before as well that we can't look at the ETF flows entirely in that framework of sentiment or that people are long or short or how they think about it, because there is also a large percentage of the market using the ETFs as a mechanism to trade in different ways.
Absolutely. Yeah, there's all different sorts of strategies, and the ETFs are a fantastic vehicle to hold spot Bitcoin with a very small fee.
Recession, we talked about this at the start. Well, not specifically, actually. We talked about growth slowing down, and growth slowing down is the precursor to a recession, because that's what a recession means, is that we've got that negative growth. We're not there yet, but there's fears about it. And when you've got the president and the Treasury Secretary, cheerleading might be a little bit too strong of a word, but they're certainly not shutting it down when people, like, if you think traditionally what would happen, you would have a reporter who would say, are you worried about us going to recession? They would say, no, because the economy is strong, we're doing well. That's not what we're seeing at the moment.
No, it's a complete opposite. And to be clear, I don't necessarily think the US goes into recession. They're still running a fairly high fiscal deficit, and it's quite difficult to have a recession when you don't have 1 million, 2 million people uptick in unemployment. You know what I mean? And I just don't think that's going to happen. We'll probably have some sort of policy shift long before that. But I did bring this along just because obviously it's the highest reading in quite a while, and I just wonder, and I'll ask you what your opinion on it as well. How much of those recession fears become a self-fulfilling prophecy until there's some actual clear pivot on policy from Trump or even the Fed, which at this point I think we're potentially going to get it from Trump first. But yeah, so what's your thoughts on this self-fulfilling prophecy?
The self-fulfilling prophecy is probably my biggest concern here, because I get that it might be clever. It might be very clever strategy to slow the economy down. But we've been here in the past, when you think about, in the Australian context, when we've had governments try to slow the economy down and quite actively move us into recession, they very quickly find themselves in a situation that they regret, because everyone might be going, yeah, that's good in the short term, but oh boy, they don't feel that way once you're 2 years into a long recession that was only meant to be a quick slow it down and then carry on in growth. So the big problem for me with this gamble, and I do think of it as a gamble, is that if you play it exactly correctly, it pays off wonderfully and we get the best of all worlds. If you play it wrong, once people change mode from growth into recession and start changing their behaviours, it's a very slow ship to turn around, and that is something that really does concern me.
Yeah, and you hear the stories all the time of people that lived through the Great Depression in the 30s. I know that was a long time ago, but those are the kind of people that never borrow money ever again. They become stable.
That's what I'm worried. Yeah, the change in behaviour, and you don't have to look back that far. I've got relatives who will still reflect on when interest rates were 18% for 2 minutes here. Like it was a short time, but it was a painful time. And boy, is that stamped into their minds. These are people who go, I'll never vote for that party again on the basis of that. Or I'll never borrow, what you're saying, I would never take debt again, because it was so painful for them that those scars lasted more than a generation. Because I'm still talking about it now, and these are quite old relatives. So hopefully not watching this. But your point is really valid as far as I'm concerned, that there's a real danger there, that people get scarred by this, and it could be great in theory, but let's see if the practice can live up to the theory, because sometimes, when it hurts people on the way, there can be unintended consequences.
Absolutely. And this chart here is, this is why I think it doesn't get that bad. Like we'll get a pivot long before then. So that bottom blue line is individual is income taxes, right? So during the sell off that we had in 2022 or down to 2023, you can see that large dip, right? So there is like a very close correlation between asset prices and the government's revenue, which they take from capital gains income, right, and taxes. So as you'll see in the next slide, the majority of the people that spend are the top 10% of earners, right? So there's a large impact of that sort of wealth effect, that when the stock market starts going down and these top 10% stop spending, that actually compounds the slowing of the economy, which is why, once again, we don't think that these policies can continue on while the markets are crashing. Now, you can, in terms of the wealth divide, a lot of people are going to have an opinion on this, whether it's fair or not. We just sort of need to look at facts, and that at the moment, the top 10% spend a disproportionately large amount of money into the economy than the lower 80%, for example.
And I'm one of those people that does have an opinion on this, but I won't necessarily dig into that side of it here. More that, backing up from that conversation we were just having, I could still see an issue even here, because that top echelon of earners who have the flexibility, on the basis of that they're high income earners or whatever, they're still also susceptible to being bitten by what happens in the market. So if
Absolutely.
they are worried about the market generally, they can park that money somewhere else. We could discuss for a long time about where they park that, but they're not necessarily going to come flooding back into a market if they're worried about that market, because as a general rule, and this is very much a general rule, they will be probably the most educated in terms of the markets as well, because they're watching it, because they've got a lot of money at stake. So if they're worried that policies are not going to act in a way that is supportive, they may, for example, move their money overseas out of the US. There's lots of different scenarios that could unfold there.
Absolutely. And this next chart basically backs up exactly what you're saying. When you've got the top 10% owning 87% of the stocks, and they're watching their wealth evaporate because of certain economic policies, if stock market's down 15%, then you can bet your bottom dollar that they've probably had at least 10 to 15% of their wealth evaporate in the last 2 weeks. Which,
and they probably noticed that.
They probably notice that. It's probably a large number. So that's how you get that spiral, right? So if all of a sudden stocks are down and the biggest spenders in the economy stop spending, then that's really going to slow the economy, and then you get those knock-on effects, exactly like you mentioned, where it just becomes a negative feedback loop.
And that really captures, in essence, my biggest concern about the risks that we face here, and why I'm not necessarily, as I said before, backing up the truck, even though technically a lot of those signs would point to that. One sign that's definitely pointing to that this is almost the counterbalance to everything you've just said, is the Bitcoin strategic reserve, because that's, who would have thought, right? Like, who would have thought we actually got to this point?
Insane. And like, I brought it because there's so much negative sentiment around it, and I think it, because at the time the price went up a little bit and then it came crashing down. If the price had just kept rocketing, I think we would have had so much, the sentiment around it would have been so much more positive. As if you look back a couple of years, this even getting spoken about would have been absolutely insane. And the fact that it's now been implemented basically strips away all the regulatory risks that existed over the last, 5 to 10 years as people, since Bitcoin's inception, really. Those things no longer exist. So that argument really can't be made anymore. And that was the main argument for a lot of people who were very anti-Bitcoin.
And I think it wedges perfectly with your discussion around the ETFs, because it was a very similar situation, really. We waited. There was all that hype into, there's other factors causing this, the pullback now, but there was all the hype into it, and then it was very much a sell the news event. But it was still, at the time, it was the most significantly bullish thing that could possibly happen to Bitcoin. Now we've had that same situation unfold yet again, and the outcome's quite similar. So it's actually fascinating to watch, isn't it?
Absolutely. I can't look away from, I don't think I've been on X as much as I have been lately ever. So
yeah, because you certainly can't look away when you go down those rabbit holes. Let's get into the technicals on this, because that's going to fine tune this analysis and really give us some specifics to look at. Isaac, you've been looking at this chart. You've been warning us about this chart, not really a warning, but telling us that this is what we've got to look forward to, right? Like that we come into the zone. What was it? Maybe you should be writing poems with prophecies, because it seems like you picked the exact top.
Well, yeah. So I was talking about this and how, when we renter this region, things are going to get harder. Tops, as we know, tops are really hard to time. And I just want to point out the funny part of this is when it says start to take profit, that green thing, like that's like the exact top pretty much, on like locally, right? That's just this funny observation there. But yeah, we're in that zone, and you know what it's looking like? It's looking like the last cycle. When you look at it, we sort of like had that peak there and then draw it down a bit. We might see something similar to that. But yeah, we're in that zone where we're aware of the macro backdrop, and there's nothing else we can really do but wait right now. We just got to look at it objectively and look at it logically. So that's the facts.
Because my take on that is probably, unlike the last cycle, it probably goes much higher when the macro backdrop changes and pushes it up, still potentially in that timing band.
Yeah.
Because the last one didn't really get that high relative to that.
100%.
But cycles are really important, and you've been digging a little bit deeper this month into just thinking about cycles generally.
Yeah. So this sheet here is used for the next chart I'm going to show. But basically, for each asset class, they follow these cyclical cycles. And I don't know, there's no actual, in terms of why these cycles occur, no one can really give a definitive answer, but they tend to work in these patterns. So whether it's a psychological thing, whether it's timing, all these sorts of things, right? But each asset class has a different sort of range. And obviously, we're doing a Bitcoin analysis. So Bitcoin likes, for weekly cycles, it likes to work in these periods. So you can cite that chart just for reference. And what it's really telling us is we're in the window right now, right? And there's actually a lot of lenience in the weekly cycles in terms of how much they can extend. And a lot of people like to look at this and say, I didn't, on this exact day, it didn't do this. But you know what? That's not how it works. So each cycle can change, and it's quite different, and these are large variants. What we've typically seen is, 203 days, 224. The other one was 197. This one, if that was the cycle low, it's going to be 217. But I don't necessarily think it is the cycle low. And there's a few things to sort of say it might not be, especially the liquidation chart. But yeah, it's in the cycle time window, and we have a few more weeks that it's still valid. If it doesn't do that, then, more consolidation on the horizon, potentially. And
yeah, really, really valid point that the cycles are very consistent, but they're not a rule of nature.
Yeah,
right? Like they're not a universal rule that has to exist, but they very consistently, you can see it visually, they very consistently play out.
Yeah.
When you think about these volume profiles, you've been looking at this quite a bit, and I think this was part of your framework where you were issuing some concern previously.
Yeah. So what we've seen is, when the last update, we were at the point of control. And so since that point, that's the ranging section there before we had the massive drop. So we were ranging there, and then what happened was we tanked from there. We had that giant sentiment flush. And then we had the announcement of that strategic reserves situation, and then we had that push up into the back into the volume profile. So it sort of flipped the support into resistance. and along with the volume weighted average. So this whole chart here is just using volume tools. So a volume profile and a VWAP, which is a volume metric. And you just anchor that. It's called an anchored VWAP. And I don't want to get too into the technicals because there's no reason to do that. But right now, what we're seeing is we're in bearish market structure. And I think until we claim that value area low of the volume region, that's our sign where things start to change. So obviously we haven't done that yet. So I have to remain locally bearish as we're making lower lows.
Is that 90,000?
Yeah, 97, 90,000, also a psychological level, and just a key level in general.
If we look at, there was a lot of discussion around the office around this CME gap because people love talking about CME gaps. It's like it's almost sometimes I think when we talk self-fulfilling prophecies, the CME gap is a self-fulfilling prophecy because everyone just focuses on it for some reason.
Yeah.
Talk us through that.
Yeah. So what we saw and why I was actually a little bit cautious for my own trades when we were entering the first touch of the CME gap is we didn't fill it fully. And then we saw that large retrace when we hit that volume profile again. And then your chances of filling that gap are quite high. So we then came to take out that gap and take the stops on that on the people who took that trade. And now we're ranging. So what I've done here is I've also put a few tools here to sort of see what would a lot of people be looking at. And a lot of people are going to be looking at that Fibonacci level, which is that golden region. People like to call it the golden region, which is pointing towards $70,000. Along with the key market structure level, which is the previous high when we went up to like the 70K region to then go to that 7-month range. So there's a lot of support in this region. And I think when we do find that bottom, whether it is now or whether it's a little bit further, it's going to be in this region. So give or take in that 70K region. I'm not going to ballpark exact figures because there's no point in doing that. And we know that's not the way to trade. So 70K region is looking very, very good.
And that's still got a bit of a pullback from where we are currently when we're recording at least.
Yeah.
So market structure, pretty straightforward here to see that we're sort of back in that red zone.
Yeah, 100%.
You're not necessarily putting timing on that though.
No, I'm not putting timing. I'm just looking at objectively what is the chart looking like. We're making high highs, what's going on. So right now we're back in the red zone. We're making lower lows and lower highs. So that's bearish market structure. So we're just going to look at it objectively.
We need to see that change. Interesting. This one I quite like that you've overlaid that with what's happening in the stock market. Is this S&P? I think you're looking at there.
It's this. Yeah. So it's the same similar thing, pretty much. So what we've seen is the red zones are points where it's pretty much 1-to-1 correlation, and then the green zone is where it gets a bit wacky. So. But generally,
that's
the
a
rule of thumb,
term, by the way.
Yeah, it's technical. But generally, what we see is the correlation rate is extremely high. So whatever the S&P is doing, that's pretty much what Bitcoin's going to do, but on a more higher percentage basis because it's a more volatile asset. And the global liquidity chart that we look at, the increase in global liquidity and how much Bitcoin increases shows that too. So yeah. Until we decouple from that, I have no other reason to assume that Bitcoin is going to follow along.
Show us something positive, Isaac. You do this every time.
Yeah. Here's our hopium chart for you, Chris.
Yay!
I think Sailor tweeted this one out, didn't he?
Yeah, he did. It was.
I was like, I don't know if that's good or concerning because I'm like, now he's doing TA. Like,
I found this on it was a Sailor parody account. I don't know if he posted on his real account.
Okay, it might have been that.
Yeah, golden cross there. There you go, Chris. So there's your Kool-Aid.
So what is that actually saying? Is that just saying that? Yeah.
Well, I mean, to me, it's nothing but a hopium chart. I mean, there is logic behind it, like this global liquidity increasing. So you'd expect it.
I'll take what I can get because this next chart is certainly not painting.
Yeah, it's not looking good, is it? It is pointing towards more downside.
So just step people through what this actually is.
Yeah, so this is a liquidation chart. So it's showing you the market positioning of most participants. Well, not most participants, but what we're seeing on a more local basis. So we can see that there's a lot of stop losses / liquidation levels to the downside. That's just highlighted by the fish finder view. So you can see those little dots and blips there. And then what they generally act like are magnets for price, because that's the way the market likes to move and likes to take out a lot of these liquidity levels. Another thing I want to point out is there's a giant whale on Hyperliquid who's in a giant short, and people were trying to stop him out on Twitter. There was like a coup that tried to band together to try and get him out, and they'd made an attempt, but it didn't work too well. But now we're still ranging. So we'll have to see what happens. If we go and retrace quite deeply towards the 70K region, it's going to be a legendary trade for that guy.
Yeah, I have been watching that one, and it is
it's a bit
it's
entertainment.
the equivalent of must-see TV for crypto nerds, really, because you just sit there watching this guy's position, having no idea who he is, and finding it all very entertaining. Certainly, watching the commentary around it as well is very entertaining. Look, that brings us to the end of the formal analysis here. We'll do what we usually do and a bit of a wrap up. I might start off with what I've sort of taken from what both of you have said so far. It's, to me, we are at one of those junctures where this type of analysis is so important. I really value the fact that we come together once a month to discuss this. I've been really looking forward to this because I'm not looking at all of the different parts, and it takes a team, right? You can't do it individually. So it's so valuable to have sort of you along, Isaac, picking out all those technical bits that we need to be looking at. Joe, you looking at that macro picture and trying to piece it all together in my head. I think for me, the bigger picture here is I'm very confident the destination is higher. What I'm not confident in is the journey to that destination. So for people holding, I'm still very comfortable that you could just be holding through this trauma, we'll call it, until we get to a point where liquidity taps are turned back on and the things that Joe was talking about. But it's going to be a journey where it's not going to be a straight line, is how I'm looking at it, based on what both of you have said and my take on it so far. So one where we need to come back in a month and really keep coming back in a month and assessing how it's going. Joe, what's your thoughts?
Well, just to reinforce what you were saying, if we do end up getting that second sell off or another sell off from here, it's not something that can be sustained. Like, we're not going into recession. We're not going to go into depression. It would potentially very much be a buying opportunity. And what we're really looking at here is a policy change from either the Fed or more than likely, Trump investment if those markets really do sell off. Because as we pointed out through this episode, if you're trying to reduce the deficit, then destroying your revenue is not going to help the cause. For those people who potentially don't have any Bitcoin at all and looking to enter, I would say it's probably not a bad spot to enter to start accumulating. But also, if you're a trader, just be cautious on the long side, and potentially just be patient.
And I just realised I've done this completely wrong, because you meant to put Isaac in the middle of this sandwich, because both of us were positive on that. We meant to put Isaac, because I'm sure he's not coming out with a rosy picture here, but try your best to end at least on a bright side note there, Isaac.
It's not that I'm not rosy. It's just, also on the backdrop of what you guys were saying too. It's a volatile time. We're in the most volatile season right now too. And what I'm locally expecting is it's hard to go against the liquidation chart, and that does have a good track history. And I do think there are some important levels to the downside that we could definitely hit. But at the same time, everything on a technical perspective, that's why it's such a tearing perspective right now. We're in that weekly cycle timing window. We've seen this sentiment flush. We've seen all these things that we want to see, which we spoke about in the last video. But there's some more deeper things which you guys have addressed. So it's very difficult. But I have to end on a positive note, as you said. So we're going up.
I was like, I don't know how he's going to turn this, but I'm very curious.
As I said, I think there's some good levels to the downside, but my base case expectation is we're going to be going up in the long term. It's what you guys are saying, and I agree with that. It's hard to go against that, because that's the macro backdrop. So you have to stick with the longer term viewpoint, because that's what wins ultimately.
He did it. He said longer term, we're all going to be okay.
Yeah.
Little pat on the back we need. Look, always appreciate that, even though I give you a hard time. Really love having the mix of perspectives here and the data to back it up. We're not just saying what we think, we're backing this up with a chart. So thank you very much for your work on that today, Isaac. Thank you very much, Joe.
No worries. It's a great one today.
Thank you.
Yeah, it was a good one. We'll be back in a month to see how that's unfolded. Hopefully, Joe and I will be cheering that, like we got it all over done with. I suspect we won't be, and we'll be once again bowing to Isaac, but let's see how we go. Anyway, thank you everyone for watching. Remember, if you have any feedback, leave that on the channel wherever you're watching this, and let us know, and we'll try and incorporate that next time. As always, we appreciate you watching and participating. Thank you for watching. We'll chat again soon.